Hello, I'm Hal Carmean of Creative Wealth Management. Over the next few minutes, I will provide an overview of the global financial markets and our perspective on them. The song remained the same during the third quarter, with the U.S. Federal Reserve and other central banks raising interest rates aggressively in an effort to counter uncomfortably high inflation. While the start of the fall coincided with hard times in the financial markets, if we look back, summer actually started on a positive note. Softening economic activity gave investors hope that central banks would increase interest rates by less than expected. This spurred a stock price rally into August. Fed Chair Jerome Powell shattered that illusion. He explained that lower growth and softer labor markets will likely be the unfortunate cost of hiking interest rates to fight inflation. His remarks sent stocks tumbling through the end of the quarter. When all was said and done, developed market equities fell by less than emerging markets during the third quarter. The US saw a relatively small decline compared to Europe and the UK. China and Hong Kong had the steepest declines, while Latin American shares had the only positive regional performance for the period. While there's no doubt that high inflation continued to haunt investors and consumers, commodity prices were actually mixed for the quarter. While gasoline is still relatively expensive, crude oil prices continued to come back down towards levels more in keeping with their long-term average prices. Natural gas prices, meanwhile, swung wildly throughout the quarter. A dramatic increase through mid-August moderated somewhat by the end of the quarter. Meanwhile, the strength of the US dollar was felt in just about every corner of the financial markets. The performance of fixed income serves as a useful lens for considering the strength of the dollar and the impact of rising rates. U.S. high-yield bonds benefit from a strong dollar and have lower interest rate risk than higher quality bonds of comparable maturities. This helped keep their losses lower than other fixed income asset classes during the third quarter. At the other end of the spectrum, global sovereigns were the worst performer, suffering from a combination of weaker foreign currencies and a high rate risk. Although the third quarter did little to soothe investor nerves, consumers and businesses remain in solid financial shape. While a global recession is forming on the horizon, we still feel asset prices will likely face further declines. In volatile times like these, we believe a focus on diversification, fundamentals, and sound planning matter more now than ever. On behalf of everyone at Creative Wealth Management, thank you, as always, for your trust and confidence in us.